Ladies and gentlemen, take a breath and remember yesterday, because what happened in the silver market was not random noise, but the opening shot of a structural repricing. I warned you that the calm was artificial, liquidity was evaporating, and the market was standing knee-deep in gasoline waiting for the smallest possible spark. When trading reopened after the holiday, silver did not climb politely. It jumped violently, skipping levels as if gravity itself had been temporarily suspended. This was not a normal rally driven by optimism, but a dislocation caused by empty order books and the sudden realization that sellers had quietly vanished. In a healthy market, prices move in steps, with buyers and sellers negotiating each inch. But yesterday there was no negotiation at all. A relatively modest buy order struck the market, and instead of moving cents, it forced the matching engine to leap entire dollars to find liquidity. That kind of price behavior only appears when the market structure is broken and the illusion of depth collapses in real time. Traders watching level 2 data could see it clearly. Bids chasing empty space, offers pulled, and price teleporting higher without resistance. This was the textbook definition of an air pocket, a zone where the absence of liquidity removes the normal braking system of price discovery. The most alarming detail is that the buying pressure was not even aggressive, meaning the move happened before true institutional demand arrived. If light buying can push silver multiple dollars higher, the question becomes what happens when serious capital finally enters the room. Yesterday confirmed that the old assumptions about resistance levels and orderly price action no longer apply in this environment. Once silver cleared its previous highs, there were no trapped sellers waiting to escape, because every holder was suddenly in profit. When everyone is winning, nobody's in a hurry to sell, and that psychological shift is far more powerful than any chart line. This is how markets transition from controlled trends into unstable acceleration phases that catch even professionals off guard. The price action was not driven by excitement, headlines, or retail speculation, but by a mechanical failure of supply and liquidity. Markets do not need panic to break, they only need absence. And yesterday, the absence of sellers spoke louder than any news event. What we witnessed was the market revealing its true fragility under the smallest amount of stress during a thin holiday session. This was not the climax of the move, but the warning tremor that signals something much larger building beneath the surface. To understand where silver goes next, we must first understand why yesterday's move could only happen in a market already primed to fail. To understand why this rupture happened, we must look beyond price and focus on the invisible structure of liquidity that normally keeps markets stable. Liquidity is not volume, it is willingness. And during holiday sessions, that willingness quietly evaporates without most participants noticing. Senior risk managers were absent, desks were thinly staffed, and algorithms were running without human oversight to absorb shocks. In that vacuum, even routine positioning trades can behave like explosives when they collide with empty order books. This is why the first move mattered more than its size, because it exposed how little resistance actually existed beneath the surface. Once the price jumped, momentum algorithms detected a breakout and immediately flipped from selling rallies to chasing strength. For years, those systems were trained to fade silver rallies, but new highs force a complete regime change in their logic. Instead of asking whether silver was expensive, the machines asked only one question: is the price going higher right now? When the answer is yes and resistance is gone, the correct algorithmic response is aggressive buying, regardless of valuation. This mechanical flip explains why the price did not stall, retrace, or pause in a familiar pattern. Each new high invalidated the previous risk models and forced more systems to join the move. What looked chaotic on the screen was actually structured behavior driven by code responding to a new environment. This is how markets move from human-paced trading into machine-speed acceleration. The absence of sellers combined with the presence of momentum buyers creates a one-way feedback loop. Every uptick confirms the thesis, and every confirmation pulls in additional automated capital. This is not speculation. It is the cold execution of mathematical rules written long before this moment arrived. Once enough systems flip, the market enters a phase where pullbacks become shallow or disappear entirely. Traders waiting for a clean retracement are often left behind as price stair-steps higher without warning. This is why breakouts in thin liquidity environments tend to look violent rather than orderly. The move was not emotional, it was inevitable once the structural conditions aligned. Beneath the paper market chaos lies a deeper problem, because the physical silver market has been quietly tightening for several years. Industrial demand has been rising steadily, driven by energy transition technologies that consume silver whether prices rise or not. Solar panels, electric vehicles, and advanced electronics treat silver as an input, not a speculative asset. Unlike investors, factories do not wait for pullbacks. They buy when inventory runs low and production schedules demand continuity. This creates a persistent drain on above-ground silver stocks that paper markets tend to ignore until shortages appear. Meanwhile, mine supply has struggled to grow, constrained by declining ore grades, rising costs, and years of underinvestment. New silver projects take a decade or more to develop, making short-term supply responses effectively impossible. Recycling helps at the margins, but it cannot offset structural demand growth from industrial consumption. The result is a widening gap between paper claims on silver and the physical metal available for delivery. For years, this imbalance was masked by confidence, leverage, and the assumption that physical delivery would never be tested. That assumption begins to crack when prices rise fast enough to change behavior across the supply chain. Refiners, fabricators, and wholesalers start to hold inventory tighter, anticipating higher replacement costs. As physical holders pull metal off the market, paper liquidity becomes even thinner. This feedback loop links physical scarcity directly to paper price volatility. What looks like a futures market rally is often the echo of a physical market that is already under strain. When futures prices surge, they signal not abundance, but fear of future unavailability. This is why backwardation and delivery stress matter more than headlines or analyst opinions. The paper market can create prices, but only the physical market can impose limits. Once those limits are felt, repricing happens faster than most models allow. Yesterday's move suggests that the physical and paper worlds are beginning to collide. This collision is most visible in the futures delivery mechanism, where paper promises are supposed to convert into physical metal on demand. Under normal conditions, very few contracts ever reach delivery, because cash settlement is cheaper and easier for all parties involved. But rising prices change incentives, encouraging some holders to demand metal instead of dollars. Each delivery request removes real silver from the system and exposes how thin the buffer actually is. Exchanges rely on confidence that most participants will never test this mechanism at scale. When confidence fades, the system must either find metal or reprice sharply to discourage delivery. This is why delivery months matter more than daily price fluctuations. A spike in delivery interest is a stress test that paper markets cannot fake. Historically, precious metal bull markets accelerate when delivery pressure builds. Silver is particularly vulnerable because its inventories are small relative to annual consumption. A single large industrial buyer demanding delivery can tighten the market overnight. At that point, futures prices stop reflecting speculation and start reflecting scarcity. This dynamic creates an uncomfortable choice for exchanges and large shorts. Either allow prices to rise rapidly or intervene in ways that damage long-term credibility. History shows that attempts to cap prices during shortages often backfire. They delay adjustment but ultimately force more violent repricing later. This is why silver moves are often explosive rather than smooth. The market spends years compressing energy before releasing it in short, chaotic bursts. Yesterday's move may have been the first crack in a much larger pressure vessel. Once the delivery mechanism is questioned, the entire pricing structure becomes unstable. This instability is amplified by positioning, because for years silver has been one of the most heavily shorted commodities in the market. Large commercial players became comfortable selling paper silver, confident that prices would remain range-bound indefinitely. That confidence created a crowded trade where downside bets vastly outnumbered upside protection. When price begins to rise inside such a structure, exits become narrow and timing becomes critical. Shorts are not buyers by choice, but by necessity, and necessity rarely waits for optimal prices. The first shorts to cover do so quietly, hoping the move will fade and spare the rest of the position. As price continues higher, hesitation turns into urgency, and urgency turns into forced buying. This is how short covering morphs into a short squeeze. Every dollar higher increases margin pressure and forces risk managers to act. What begins as a controlled reduction can quickly become a cascade. The irony is that short sellers provide the fuel for the very rallies they dismiss. Their buying is not optimistic, but it is relentless. In silver, where liquidity is already thin, this effect is magnified. A relatively small number of forced buyers can overwhelm natural selling. This creates sharp, vertical moves that defy traditional technical expectations. Charts stop behaving statistically and start behaving mechanically. Analysts searching for overbought signals often misunderstand what they are seeing. A squeeze is not about valuation, it is about survival. Once the squeeze begins, it tends to run much farther than logic would suggest. Yesterday's action shows early signs that this process may already be underway. Adding to this pressure is the macroeconomic backdrop, which has quietly turned supportive for hard assets after years of monetary distortion. Persistent inflation has eroded confidence in fiat currencies, even as official statistics attempt to understate the damage. Investors are no longer debating whether inflation exists, but whether it can be contained without systemic consequences. Rising interest rates were supposed to cool demand, yet they have instead exposed how fragile debt-dependent systems truly are. Governments face an impossible trade-off between defending currency value and sustaining economic growth. History shows that when this conflict intensifies, policymakers eventually choose debasement over discipline. Silver benefits disproportionately from this shift because it straddles both monetary and industrial roles. Unlike pure industrial metals, silver absorbs monetary fear, and unlike gold, it remains undervalued relative to its utility. This dual nature attracts both investors seeking protection and industries that cannot function without supply. As confidence in policy weakens, capital migrates toward assets outside the financial system. Physical metals represent a form of insurance against policy error rather than a bet on growth. Central bank credibility matters until the moment it doesn't, and those moments arrive suddenly. When trust breaks, markets reprice narratives that were once considered unthinkable. Silver's small market size makes it extremely sensitive to even modest reallocations of capital. A tiny shift out of bonds or equities can overwhelm available silver supply. This asymmetry is why silver rarely moves gradually during macro regime changes. Instead, it remains quiet until pressure reaches a threshold, then reacts violently. Macroeconomic stress does not announce itself politely, it expresses itself through dislocations. Yesterday's move fits this pattern more closely than most observers are willing to admit. The macro environment suggests that this pressure is not easing, but accelerating. Psychology completes the picture because markets move not just on facts, but on how quickly beliefs change under pressure. For years, silver conditioned participants to expect failure, retracement, and disappointment after every rally. That conditioning created complacency and reinforced the habit of selling strength rather than respecting momentum. When a market violates deeply held expectations, reactions are delayed, confused, and often wrong. Traders anchored to past behavior struggle to adapt to new regimes in real time. This hesitation creates opportunity for price to move far before consensus catches up. The most powerful rallies begin when belief lags reality. Early participants act on structure, while the majority waits for confirmation that arrives too late. As price continues higher, disbelief slowly transforms into forced acceptance. That transition is emotionally exhausting and financially costly for those on the wrong side. Media narratives shift only after price has already done the damage. By the time bullish explanations feel comfortable, risk has already increased. This is why markets reward preparation rather than prediction. Silver's reputation as a frustrating asset is precisely what makes it dangerous during regime change. Nobody expects it to work, which means few are positioned correctly when it does. Crowded skepticism is the fuel of asymmetric upside. Once belief flips, positioning must be rebuilt at much higher prices. That rebuilding process adds another layer of demand on top of existing stress. Psychology does not lead these moves, it chases them. Yesterday's price action suggests belief is only beginning to shift. All of these forces converge toward a single conclusion, that the silver market is transitioning from suppression into discovery. Discovery is not a smooth process, because it requires markets to admit past prices were fundamentally wrong. This admission never happens quietly. It happens through volatility, gaps, and rapid repricing. The role of price is not to be comfortable, but to clear imbalances and force alignment between belief and reality. Silver's small size ensures that this clearing process will be fast, uneven, and emotionally intense. Attempts to trade it like a large, liquid market are likely to fail under these conditions. Risk management now matters more than prediction, because outcomes will arrive faster than narratives. Those who wait for certainty often pay the highest prices. Structural moves do not announce their endpoints in advance. They end only when pressure is released or forcibly reset. What happened yesterday was not the end of the story, but the beginning of a different phase. The market has signaled that old playbooks are losing relevance. Participants must adapt to a regime where volatility is information, not noise. In such regimes, patience and discipline matter as much as conviction. Silver will not move in straight lines, but its direction may now be clearer than its path. This environment rewards those who understand structure over those who chase headlines. The greatest risk may be assuming that tomorrow will behave like yesterday. When markets break from long-term constraints, they tend to overshoot. Overshoots are not mistakes. They are how systems correct imbalance. The repricing process has likely only just begun.